What's up, party people? My name is Sunny Ray. This is the Sunny Ray Show. I've got, I think, 3 or 4 guests lined up today for you. I'm going to start with a gentleman by the name of Bryan Walley. I hope I'm saying his last name correctly. This will be a really interesting one, something that I think a lot of people are maybe thinking about, but maybe a bit confused in terms of like how to actually tackle it. I know something that on a personal level, I'm also thinking about it as well with my family. And so Bryan is a career fintech operator who spent most of 2 decades inside the plumbing of money movement before deciding that the plumbing itself was the problem. He then went on to essentially work on, which we're going to be talking about today. He's building an inheritance company called Forward Inheritance, also called Forward Financial. And today, roughly $84 trillion is expected to change hands between generations over the next 2 decades, right? That's about $35 trillion of American wealth sits illiquid in home equity. And only about 40% of homeowners have both a trust and will in place. So just imagine how ginormous of a challenge that is. Bryan, happy to have you here. How you doing, bud?
Sunny, it's an absolute pleasure. Thank you so much for having me. Excited to have our chat.
Cool. Yeah, happy to get excited to get started. Um, so I guess I like to always kind of start by going right in the deep end. What is Forward Inheritance? What are you building? High level, short for now, but then we'll obviously go deeper into it later on.
Yeah, fundamentally, Forward Inheritance is a platform that will store, secure, and organize all of your estate documents as well as your family assets so that we can optimize your wealth over the next days, years, months, decades, and generations. We're here to serve your family at the end of the day. That's fundamentally what we're doing, Sonny. It's the most noble mission I could think of, is serving other families.
Right. And my audience tends to be a lot of founders, some investors, but mostly I would say founders, entrepreneurs, tech people, right? That are obviously working really hard, building businesses, amassing wealth. But then yes, like many of us get to the stage that I'm at now where you're like, oh wow, I have 3 kids. I don't know if that background noise is picking up the 2-year-old, but you start to think about, your parents are starting to get older and start to think about things like this. In fact, I had a conversation with my father just this past weekend or 2 weeks ago when I went to Edmonton about this matter as well. And I mean, I don't think it's rocket science, but it is something that requires forethought and planning. And so, yeah, excited to dig in and what it means for that audience. So, I guess kick me off. I my favorite thing to do, Bryan, is before we talk about the tech or the business or all of that, is to kind of understand people's hero's journey and like why they're doing what they're doing. And so you describe yourself, basic like a basic fintech guy, right? So can you basically a fintech guy, walk me through what that meant like day to day, because 12 years at City National running Exactuals is a very specific kind of fintech, not the consumer app kind. So can you talk a little bit about that?
Sure. So the way my career progressed was it was typically in B2B automation. So I ran the ticketing point of sale system at Mammoth Mountain Ski Area, where 2/3 of Mammoth's revenue came through my software, and I had to do the back end financial reporting. And I was like 23 years old, and I wore a belt and shaved that day. So I was probably the adult in the room, which was wild. After that, I was the first W2 at a Sequoia Capital-backed startup called IP3 Networks down in San Diego. That was networking equipment on steroids, and that was a super fun time from 03 to 06. I really got into fintech in 2006 at City National Bank, and we basically automated all of the APIs inside of online banking, commercial online banking. So everything you can do inside of commercial online banking, let's expose that with an API and let's connect it to a general ledger and an ERP system so that you didn't have to do double entry. You didn't have to book it in the GL and then go to online banking and move the same money. Now that's convenient for a normal business. There are specialized businesses in the entertainment industry that are making thousands of payments a day. And when you're making thousands, putting in, call it payroll once in your GL and putting it into online banking once a day, that's doable. It's not efficient, but it's doable. When you're doing thousands of payments a day, that's not real life. So we exposed that API back in 2007. which, was relatively groundbreaking at the time, an API to move money in 2007. And that system actually still moves billions of dollars annually, which is great. I went to Intuit Financial Services, and I got to see a much broader view of the banking system and the payment system, right? They were serving 4,000, 5,000, 6,000 banks in their digital insight platform, as well as obviously all the QuickBooks Online infrastructure. So that was a great thing to see scale. So I got depth at City National, and then I got scale, if you will, and breadth over at Intuit Financial Services. I came back to City National Bank, much like you. I had a second child along the way. I was, moving up in my career. And so I went back to City National Bank, and at the time met Mike Hurst, who is one of the co-founders of Exactuals and the CEO. And I helped lead the A round in Exactuals from City National Bank. And then joined as employee number 6, chief operating officer, about 6 months later. And we were an independent company for 5 years, then bought back by City National Bank, Royal Bank of Canada, which I know I do love the Toronto area, and came back. We were independently operating for 5 years, and then post 2023, 2024, really was looking around at what I wanted to do next. And there were some personal things that helped me get to forward inheritance. There was a point in the family's life where I had to look my father in the eye and be like, "Hey, Pops, where's the will?" And he's like, "It's fine." And I'm like, "We're past it. It's fine time, pal. I need your paperwork." And that was a really hard conversation for the family. I had to call a family meeting. My 3 sisters had to show up. We all had to look each other in the eye. Like, Sonny, that was tough, man. That was really hard. And it mattered because we had that conversation over the kitchen table, not a hospital bed. And that is how you have family communications and estate planning and good relationships, so that we can have an estate, so that we can have the inheritance, so that mom and dad can ride off into the sunset. I know I've been monologuing a little bit, Sonny, but you asked me where I came from, and that's how I got to forward inheritance. It really comes from candidly, Sonny, you and I are the sandwich generation. We are raising parents. We are raising children. We are all looking around saying, do we have it? We're the adults in the room. And how are we helping us answer that question to ensure that we have organized our lives, made sure the estate is safe, made sure it's properly insured, made sure it's properly covered, made sure we have long-term care coverage for mom and dad, grandma and grandpa, made sure that we have 529 plans for the next generation. How are we running the business of the family like a business, so that we are having better outcomes and making more money, saving more money, so that we have a family legacy to pass on to our children? Because that's what it's all about. It's not about, look, the money matters. The money is not the point. Legacy is what matters. Giving a good foundation to the next generation is what matters.
Yeah, that's really powerful, and it resonates. I was going to ask you something. So you spent like 12 years inside of a bank is kind of a long time, right? So what did you learn there about the gap between kind of like what a financial institution can build and what it will build?
Yeah, I think in the best possible ways, what is a depository institution responsible for? They take in your dollar, and when you come back the next day, they better have a dollar to hand back to you, right? I mean, it sounds super fundamental, but like at the end of the day, what do we do? We're trusting them with a dollar and saying that dollar will exist tomorrow or the next day or what have you. And so by nature, and I would say appropriately by nature, commercial banks are supposed to be conservative, right? So at City National, I learned what it was like to ensure that you have, are you double checking everything? How is the security? How are the social engineering, and how are we making sure that everybody's safe? How are we managing risk appropriately? How are we ensuring that dollar exists in the depository institution, right? I wasn't so much a lender. There are really great bankers who are lenders, and I know them. They're all my friends, et cetera. I was much more the payments guy and the reconciliation and to the penny, and making sure that the system flowed and reconciled on a daily basis and the ledger was square. And I think that kind of discipline and rigor and risk management and security and adulting, for lack of a better term, is one of the fundamental things that I learned working in commercial banking. It may not be the most exciting place. Man, it's fundamental and foundational and a bedrock and required. And so maybe you don't want the most exciting thing to be happening when it's about ensuring that you have a dollar right in the depository institution. So that is what that system is set up for. And you almost need innovation to happen outside that system for all the right reasons, right? You have two diametrically opposed goals. One is something new. Try it. Let's experiment. Let's see what happens. That is the opposite of what I want my depository institution to do, right? I want them to have that dollar guaranteed when I show up the next day, right? So there's a conflict there, or a tension that I think is healthy and okay. And that's what has the really robust fintech called space that I love to play in, that eventually the depository institution's commercial banking needs. That's in lending, that's in payments, that's in all sorts of areas. But you got to hash it out in a safe way first so that you can migrate it to the very safe bedrock place that everybody can trust. Does that resonate, Sonny? Does that make sense?
Yeah, definitely. And so Bryan, like, who or what shaped how you think about financial products? Like, any operators, books, or ideas that you keep kind of like returning to?
Indeed. Look, Morgan Housel's The Psychology of Money is a fascinating look at just, well, the psychology of money and how people respond to it, which is interesting. I think if I had to go back to mentors, I was lucky enough, and this is going to be an old school drop that no one may remember, but First Interstate Bank was a massively great institution in the late 80s, early 90s across the Western United States. It was purchased by Wells Fargo, and that's part of what helped Wells Fargo really expand its footprint and its growth, and that was awesome. A lot of those First Interstaters who did not go to Wells Fargo migrated over to City National Bank. And when I started at City National Bank, they were a $3 billion, known as a regional bank. And, now they're a wholly owned sub of Royal Bank of Canada. They might just be considered, the growth has been spectacular in those last 20 years. And so it was really fun to see how a appropriately conservative organization can innovate, can grow, can do new things, and can expand, which is exactly what City National did. And credit to a lot of my mentors like Janice Chung and Natalie Russell and Chris Carey and Mike Cahill and Chris Wormuth and obviously the Goldsmith family. There are just too many to name at City National, but man, a lot of those First Interstaters, Bert Rothman, they were just fantastic mentors to me and taught me how to conduct myself, how to behave, how to treat a customer, a client, a family member, a human, how to treat them appropriately, right? And earn a fair nickel while doing it.
Interesting. And looking back, across like payments, banking, tech, and now inheritance, like, what's the through line? And because from the outside, it looks like you've been circling the same problem for almost 20 years.
Yeah, there was my information systems professor at USC had a great phrase, and it was, "We do not automate cow paths. We do not pave cow paths." And so that's really the through line, Sonny, is like, hey, what's the business outcome? A to B, cool, earn a nickel, whatever it is. Let's understand what's the most efficient way to do that, and let's automate that path. Just because the paper process had a meandering cow path does not mean that's how you automate it. Right? You have to come back to first principles thinking, say, what's the actual outcome here? What can we control? How do we get it done? And then go deliver that. And it's got to be materially better, right? If you're going to pave a cow path, or if the cow path exists, people know how to get there, right? Cool. You need to have something that is 10x better, 100x better, right? Really improve people's lives, and they'll pay you for that, right? So that's the through line of my career, is looking back at a process saying, oh, that's a cow path, I can fix that. And then figuring out what's the best way to have let's say a 2-lane highway, not a paved cow path from point A to point B. That's probably the through line, Sonny.
Super cool. You said like earlier in the conversation that Ford started when you hit estate planning complexities in your own family. Yeah. What did you actually discover when you went looking for the paperwork?
Yeah, sure. So my mother passed away when I was young, and my father figured it all out, and none of us had any idea, or at least I didn't. I don't believe my sisters and I had any idea how much he carried at that time, right? And so it was a few years ago when I had to get the estate paperwork from my father, and I was like, "There's an 8th Amendment on this will, Dad." And my dad's like, "No, it's not an 8th Amendment on the will. It's an 8th Amendment on the prenup." And I was like, "Oh my God, Pops! Like, what are we doing here, pal?" Because my experience was, I was recently divorced. I had to go get a new trust, right? You go get your new paperwork when you're divorced, right? And so I went to my friend who's an estate attorney, and I was like, "Hey, I need a new trust." And so sure enough, she wrote up a new trust and she hands it to me and she goes, "Cool. fund your trust. And I was like, I'm sorry, what? I just paid you thousands of dollars for this document. Like, we're good to go. And she goes, no, now you need to fund your trust. And I was like, I don't understand what you mean. And she goes, yeah, you do. And I go, no, I don't. And Sonny, that was one of the big moments where I was like, oh my goodness. Like, I was born in a very nice place in Southern California. I live in LA. Like, I've had a nice career. I have beautiful children. My father's with it and done really well with his planning. And I had no idea what my estate attorney was asking me to do. I had no idea if I was prepared. And I was like, oh my gosh, if I'm in this spot, I wonder how many other people are in what spot, right? And that was the real unlock for me, where I was like, oh gosh, how do I solve this problem for my own family? So I went looking around for systems where I could store this and I could do this. Now I had an idea in my head of what I needed and what I wanted and why, and it didn't exist. And I was baffled. So I kept looking, and it didn't exist. And like, Sonny, I was like, we need to start a company about this. Like, I need to solve this problem for me, for my family. So like, my family's record number one. So like, it's super cool. All the other families we serve, and I love them. And you know, that's a great business. Man, at the end of the day, the team is building for ourselves. We're all in the sandwich generation and we need our own help. And so that's what we're doing. We're drinking our own champagne, Sonny.
This term sandwich generation, right? So we're raising our parents, raising our kids, and looking around being like, where's the paperwork, right? So can you unpack that for the people like who haven't quite hit that moment yet? Because like I said, I just recently, like literally in the last few weeks, had that moment and that conversation with my dad. Thank goodness he's like, it feels like at least he's on top of it, and he always has been. And so yeah, so it was a bit like seamless, to be honest, but I could see how, you know, most people it would be just like a hot mess.
It is because it's tough. Who likes talking about their own mortality?
Yeah,
right. Who likes admitting that they're going to die? Who likes admitting that their parents are going to die? Like, none of us. All of us just like went, I don't like any part of the last 15 seconds of what Bryan was saying. And yet it's true. And we don't talk about this enough, right? Like, not liking gravity doesn't mean that the coffee cup's not going to fall off the table and break. Like, it doesn't matter if you like death or not. It doesn't matter if you have grokked that all of this ends. What matters is that you prepare for it, right? And so I think one of the best things that we've been able to do, Sonny, is we have 5 conversation starters that are about the estate that have nothing to do with money. Because like, yeah, of course, money's the goal, right? We all care about what's the value of the estate. Like, I'm dumb, but I'm not stupid. Fine. But money's the outcome, not the actual reason why we're doing this. I think the reason we're doing this is I think there's an inherent human need to give the next generation a better life than was given to you. I think there is an inherent human want to help. And I think there is a massive opportunity to have better family communications so we don't have intergenerational financial trauma coming down from one generation to the next. So our experience is you don't ask mom and dad, where's your estate? What's happening? I need all the things right now. Like you're attacking. Like, that's not going to go well for any human being. One of the ways we can say is, hey, Pops, I had to go get my own trust after my divorce. Where's yours? Do you have one? Where's it located? All you've done there is just ask, is there a document? Where is it? You can kind of figure out how up to date it is. And it has nothing to do with money, but that's going to protect your estate. That conversation, that very simple, just how you doing? Where is this? This is happening to me. Has that happened to you? How did you handle that situation? Asking for advice and kind of slowly dripping out the information from our parents might get them to talk about finances and the estate and the plan and what their plans are. How do they want to live? Do they have the funds for it, etc.? We can have this conversation with them in a very loving, elegant, calm, familial, right, supportive way, not attacking them about, hey, that's my money and I want it now. Like, as a human, that's rarely going to go well. So I think in encouraging these good family conversations will then allow the space and time to have, to look at, is there a trust? Is there a will? Is there a power of attorney for medical decisions, financial decisions, what have you, so that we can understand, are the operating agreements of the family in place? Cool. Are the assets of the family and the liabilities well documented and tied back to those operating agreements? Cool. We're in a really good place. We're overinsured. We're underinsured. We're right-sized insured. Whatever that is, then we can have really good conversations about, Mom, Dad, how do you want to use the money? Do you want to take pictures? Great. Let's spend it all and just take photos, right? It's your money, mom and dad. Do what you want with it. But at least we know what the plan is and we can honor their wishes, right? Like, let's honor the people, the founders of the feast, the people who made all this possible. Let's help them. That's, yeah.
And then Bryan, the other line, right? So can you help me maybe pick that one apart? So free money when you're 60 years old, that's super cool. When you need it is when you're 30. So when did the timing problem click for you as a real problem rather than the paperwork?
Yeah, look, it's really great. My father is 81 and still plays golf multiple times a week, scuba dives. Some would say he still snow skis. I'd like to think he still water skis. That's debatable, but he's 81. That's cool. So you know what I mean? So like, that is not, when we used to say 40 is over the hill, 65 is retired, right? That is not an 81-year-old going snow skiing. You know what I mean? Like, those two things are diametrically opposed, right? So inheritance, mom and dad are living longer, which is awesome, right? We are healthier, we are living longer. And what happens is when you are living longer, which is obviously not leaving their homes, all of those are statistically backed up things. You can go look at the data. That's fine, right? So mom and dad, grandma and grandpa living longer, not leaving their homes, healthier, which is going to require more money. Have they saved enough for retirement? Question number one. Do I need to help them with their retirement? Question number two, right? So because of that, which is awesome though, because mom and dad are living longer, inheritance is delayed, which is a interesting repercussion of the awesomeness of mom and dad, grandma and grandpa living longer. If you can think about when, let's just say parents died at, I'll just say age 70, maybe their kids were age 30 at the time, right? And that's when the 30-year-old got the inheritance, which was help with the down payment of the house, which helped them be maybe debt-free from college, which helped them start a business, which helped them pay for the grandkids' education, all of those great things. That used to happen when we were like 30 years old. And now it's not happening until the next generation is like 60 years old, which is, look, it's always beneficial to get a chunk of change, full stop, no matter what. But you kind of need it when you're 30. It's gravy when you're 60, or hopefully it is gravy when you're 60, right? You need it when you're 30. And so there are now new financial tools and ways that we can access a portion of your future inheritance today, tax-free, without any money leaving mom and dad's bank account. And we can help families with that. It's a great solution for many, many families. It's not the right solution for all families. Nothing ever is. And that's okay. But this delayed inheritance problem is creating interesting structural society problems, right? It's hard for a 30-year-old to find a house these days because mom and dad are living longer, because they're not leaving their homes. Like, these are interesting societal broad stroke trends in society that I think we can relieve some of that pressure with some new financial tools. I think we can relieve some of that pressure with some good planning. Let's organize what the estate is so we have a really good idea of the best way to optimize it. Maybe that's something with your wealth manager. Maybe that's with your tax accountant. Maybe that's with a home equity investment. Maybe. How do you know until you've organized it? So first you organize it, then you optimize it, Sonny, and we can allow the next generation to access a portion of their future inheritance today safely with no money leaving mom and dad's bank accounts. Pretty novel stuff. It's great.
Are we talking about like universal life? Are we talking about annuities? Like, what are you getting at here? Just curious.
Yeah. So one of the largest assets.
And I used to have my life insurance license like 2 decades ago, so I know a little bit about this stuff. But I'm just curious, like, when you say, yeah, what do you mean? Yeah.
So one of the largest assets in any estate, I'm just going to say this generally speaking, is the family home. Right? It's cornerstone of the American dream. Everybody owns a home. Isn't this great? And it is. And look, there have been dramatic policies for generations in this country to encourage home ownership, right? So mortgage interest deduction, things of this nature. Fine. Trillions, 35 trillion. The math is so big. The debating about this small answer doesn't change the big answer. It doesn't matter what the number is. Is it 10 trillion? Is it 35 trillion? Like, cool. Trillions of dollars exist illiquid in mom and dad's home, grandma and grandpa's home, and they can't touch it. And conventional wisdom in the wealth management world was spend down all of your liquid assets and your home is the last thing, right? Your nest egg. It's the last thing. Is it really the best financial advice to spend all your cash to then be concentrated in one asset that has variability in pricing? And I'll say dramatic variability in pricing, that in theory, deteriorates as mom and dad get older because they're not doing the maintenance on the house. So the value of the assets actually decrease. It's not accelerating at the same rate as that asset would with a younger family in that home. So like, is that the best advice? I'm just asking the question. That might be a bit of heresy in the wealth management world, but I believe it's at least worth asking the question and answering it a second time. I don't know if that's the right thing to do. So what you can do is take, let's say, a very, very safe portion, the bottom, call it $100,000 of that equity, that grandma and grandpa's house or mom and dad's house, and we can use a home equity investment to get it down to the family and to the next generation with a combination of the gift tax and lifetime exemption. I'll help you file your 709 form for your lifetime exemption so that we can get $100,000 or $50,000 or $250,000 to the 30-year-olds today, which is basically their future inheritance today, tax-free. No money is left mom and dad's bank account. So a lot of families are using it for the next generation. A lot of families are using it to take the tax liability from a traditional RIA to a Roth IRA. When you convert the RIA, you have a taxable event. Cool. So let's say you owe, I don't know, 100 grand in taxes. You can take that out of the illiquid equity of your home. You can pay that tax bill. Now you have a Roth IRA, which doesn't have required monthly distributions, which means your AUM stays on your books longer, which means the family is wealthier longer, which means the wealth manager makes more money, which means we can allow for mom and dad to live longer and still have the funds to pay them, right?
Who pays the interest on that HELOC or whatever?
So it's not so. Reverse mortgages are up here. HELOCs are down here. Think of it as like a little bit more of an expensive HELOC with no monthly payments, right? Depending on the economics of the property, it could be like 12.9%. So think of like HELOC plus, right?
Got it.
But no monthly payments. It's a good bet for the right family. It does not have monthly. It doesn't add monthly payments to mom and dad, and grandma and grandpa can't even get a HELOC because they don't have the income required to cover the monthly payments. So it's a really good solution.
But they are essentially taking this loan against their home, right? That makes sense. And then like when or if they, at one point when they pass away, their home, but that debt is now still owed.
It's okay.
So who pays that debt, right?
So I don't want to be
fall upon the inheritance, right? Or something like the children?
Sorry. I'm talking over you. I believe I know the answer to your question. So just one, for the regulators, it's not a loan legally in the United States today. It's an option contract. Okay. So I'm just going to say those words so they're out there publicly. Fine. Okay. That is being adjudicated in the courts. I think over time, how do I say this? I don't care what the answer is. I care dramatically that the family's taken care of, that there is an answer. I don't care what the answer is. Just give us clear rules and we'll play by them. Yeah. So like, that's my stance on where that's going. Fine. Okay. So to answer your actual question, we get paid back 4 different ways. You can always just pay us off. Cool. Like you have the cash, you can just pay down, right? It's an option contract. You can just pay off the contract. No factor. Okay. 2, you can refi us out. Right? You do a refi, you could, take out just like you refi a mortgage or refi a HELOC, you could just refi the home equity investment out. Cool. You can sell the property and that's what takes us out, right? If we don't have an ownership interest in the property, that's how you get paid. Or you can estate us out, is that 4th way is what we talk about it, right? We're 30-year paper and we're very patient and we're here to help families. So that's where our partner Ford and that's where our partner Cornerstone is really great.
Interesting. Cool. Okay, so only about 40% of homeowners have both a trust and a will, right? So that number has been, stable for years despite everyone, knowing better, right? So what's the actual blocker and why has, more education not moved it?
Yeah. First of all, that is a train wreck waiting to happen because without proper planning, paperwork, and process, without a trust and a will, and I'm just even going to say, like the trust is almost option, like without a will, defining that this is your family asset. Okay. If mom and dad pass away without a will, the home goes to, all the assets, but the home goes to probate. What probate is a very needed, very good portion of our state governments that say, oh, we don't know who owns this asset. The state will own the asset for a bit, right? We'll put it in a little special holding area called probate. And then, people who have claims on that asset can come and prove that that is their asset. Cool. So all that seems super rational and normal as a policy, right? What that actually means in practice is that your heirs will spend years arguing with the state that you live in, not they live in, that you live in, like that mom and dad live in. They will spend years arguing with them that that is the family home. And after a couple of years, the state will probably go, yeah, you're right. And, give you back title to the family home. And you've wasted 10, 20, 30, 40, 50% of the value of the estate. Like you've wasted time and money and energy and stress and chaos and all of this for something that could have been handled for like less than $100, right? Like one time you could have just said, hey, for $100, this is what we do. Right? This is our asset. And then you have legal claim to it and the state doesn't have a question.
And Brian, you're talking about the will right now?
Yeah.
Like you're saying in the absence of a will. Yeah. It's an absolute mess. Yeah, exactly.
It's an absolute mess. So why? So why has this not been improving? I think it's twofold. Okay. Mm-hmm. One is there's a mañana problem is what I like to call it. People care about the state of the estate in 5 times in their life, right? It is the marriage, it is the birth, it is the divorce, it is the medical problem, and it is the death. No one can help on the 5th one. Don't let anyone fool you there. So what happens is on the marriage and on the birth and on the divorce, everybody knows they got to go get paperwork, right? And I'll do it mañana. Oh, yeah, no, Sonny, I know. Sonny, I know I got to go do that. In fact, my friend's an estate attorney. I'll do that mañana. The medical problem, mañana becomes right now, real quick. Mom fell and broke her hip. Where's the power of attorney for medical decisions? Dad just got a dementia diagnosis. Where's the power of attorney for financial decisions? Where's the will? Where's the trust? A medical problem is when mañana becomes today really quickly. Couple that. So A, that's, I think, a human psychology. B, the value of the estates have gone up with home prices going up and more people being wealthy, et cetera. And now it becomes really obvious that you need to protect this stuff, right? Once you get a certain level of wealth, then you start insuring against the wealth going down and the whole bit. So there's that. And I think the third comes back to generational ability or stereotypes about talking about hard things and talking about feelings and talking about difficult conversations. And I think, look, World War II generation, yeah, they came home and it was stiff upper lip and probably drinks at lunch, man. And I get it, right? I think Vietnam came home and they were they were better about talking about like, hey, that was terrible, but they aren't the best at it. And then you have someone like you and I, Sonny, and yeah, a lot of our friends go to therapy and a lot of our friends talk about their feelings and we do this kind of stuff. And the next generation is just dramatically better about all of this processing than all of us are. So I think we're now starting to have the ability to have these hard conversations in between the generations because of almost a generational evolution, if that makes sense. And like, that's a kind of a bold woo-woo claim, but like, does that make sense?
Mm-hmm. Yeah. And where does the great wealth transfer become the great probate? Like, can you describe what the failure actually looks like for a family in the room?
Yeah, sure. So the great probate happens when the family does not have family conversations around the kitchen table about what is the plan. Are we prepared? Where are the documents, etc. So look, you can ignore it all you want and be like, oh, that's never going to happen. And that's exactly how you lose half your family wealth and a bunch of years and all this sorts of stress. So the lack of preparation shows up when you least expect it. Mom fell. Dad had a car accident, right? Like just oh my gosh, this is the worst Wednesday ever. That's when it happens real fast because you don't have the weeks, months, quarters to get everything together in a nice orderly process and ensure that everything is ticked and tied, right? You need to start that. Sonny, when's the best time to plant a tree? It's 30 years ago. When's the next best time to plant a tree? Today, right? Look, you could have started planning 30 years ago. Maybe you did, maybe you didn't. Maybe mom and dad did. Maybe mom and dad are not prepared at all, right? As they expected to die at 75, and now they're going to live to 95. Right? How are they going to feed themselves for the next 20 years? Where are they going to house themselves? What does long-term care look like? Right? That's wild. So do we have enough money for mom and dad? Can they ride off into the sunset the way they want to? And so what we can do here is we can allow the families to have this planning together so that we're making better family decisions and optimizing for the business of the family so that we have that legacy to pass on to the next generation, so that we have that wealth and that foundation where they can thrive. Which is, again, I go back to call it a fundamental human need and want, that our next generation is allowed to thrive. And I think this is part of that equation.
Wait, was there a moment when like a family used the product and then something happened that you maybe didn't design for?
You know, that's a great question. I think what I really like about it, it's really the stuff. So how do you prove that you prevented a crisis? That's a hard thing to prove, right? Hard to prove that you prevented a crisis. Okay. What I do love is that we are getting reports now already of families who are like, oh my gosh, I got to not only look at all of the, call it personal effects that I'd like to give my children. I got to say, all right, this watch goes to my son, this necklace goes to my daughter, right? And really go in and look. We had this family, she's in my mind recently because she went through all of her personal effect. Her mother passed away earlier this year. So it allowed her to give that time to really grieve and really think about what her plan is going to be with her two children, and sat down and just mapped everything out. And she was just like, Bryan, this weight has been lifted off me. Not A, just because I know it's good and handled and settled, but B, she got to share that plan with her kids and have a conversation about it. And they got to like understand like, oh, mom, that's what you want to do. And I got to hear the story of this family. And it was just a beautiful thing, Sonny. Like, I go back to the nobility of this business. Like, what an honor it is to serve families across America, and B, hopefully more over time, right? We earned the right to be, to help families save and make money for generations. Preventing a crisis, proving that you prevented a crisis is tough. Fine. Seeing the outcomes of good family conversations and good family communication around what the estate plan is and what the goal of the inheritance is, that's beautiful. And we're seeing families do that, Sonny. And man, I will do this all day long. It's such an honor. It's such an honor.
Can you give me the two products plainly? Like, what is the FAM Inheritance Portal and what is Forward Access?
Yeah, sure. So the FAM Inheritance Portal, what we like to call the Forward Asset Management System, hence the FAM, it has two parts to it, right? So one, we organize all of your assets and we organize your documents and we link them. Think about your homeowner's policy has $15,000 of personal coverage, but you have $200,000 of art, jewelry, cars, what have you. You have an insurance problem. We will identify that systematically and say, hey, Sonny, you might be underinsured here. Would you like to fix that, right? We might look at your high yield savings account and say, hey, your high yield savings account is 50 basis points off of market. Would you like one that makes you more money? We can do those things systematically. So that's the FAM, right? And then there's the neighborhood. So the neighborhood is an internal marketplace that we like to call Costco for your estate or Angie's List for your estate. You can find wealth managers, you can find home equity investments, you can find high yield savings accounts, you can find what's a Roth IRA and why do I care? Cool. Then there's Forward Access. And Forward Access is a home equity investment financial product that you do not have to use in order to use the FAM. Like, the FAM is what it is. And one of the many things that we sell in our neighborhood is Forward Access, if that makes sense, right? And so that's that home equity investment product that allows you to access a portion of your future inheritance today tax-free, or use it for long-term care, or use it for the traditional to Roth IRA conversion, right? You can use it, you can take the energy stored in the illiquid equity of your home and use it to help move your family forward. And that's why it's called Forward Access.
And just with regard to that, probably one more time. So where's the catch that, a family should think hard about before signing?
Yeah, sure. Look, every financial product, the bill comes due, right? Cool. So if you are going to take out a $100,000 HELOC, you're just going to start paying interest on that $100,000 HELOC until you pay it off. And it probably has a 7-year term, maybe a 10-year term, whatever. Cool. Some are out there now with longer terms. So there are, like, I'm just saying, like, that innovation is also happening. Great. Maybe that's the right thing for your family. Everyone kind of understands what a HELOC is, right? You have your mortgage and then you have your second, right? Your home equity line of credit. Cool. What if instead, if you added up actually all your payments, okay, let's say the interest rate right now for a HELOC is called prime plus 200 basis points. I'm inventing numbers, so don't, right? So right there, you're looking at 8.5%, 9% money, right? For a home equity or for a HELOC. Plus monthly payments that you have to come out of pocket for every single month for a short duration. Cool. Or you could take that same $100,000, put it in your pocket, have 0 monthly payments, and we just accrue them, and that's just accruing over time. And then after up to 30 years, your discretion, no prepayment penalty, you can come in and just settle that bet. And like I said, there's 4 ways to settle that bet, right? Pay us off, refi us off, sell us out, or estate us out. That's fine. And that's up to you and your family. And yeah, we accrue that number and then you pay it off. And that's when our investors get their money back, right? So instead of getting the drip, 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 drip of the home equity, of the HELOC, right? The home equity investment just accrues it and then pays it off in one lump sum. And typically that's where you pay it off in those 4 big events. And so it's not so much a catch, man. There's a higher interest rate because it's the time value of money and there's no monthly payments. Does that make sense? Like eventually.
Yeah. I get it. Okay, yeah. But I mean, if I took out it, but I'm going to end up paying that interest, right? Because like you said, it's accruing on top of the 100K. And so at the end, when I'm paying, it's not going to be the 100K. It's going to be 100 plus, let's say 12K or whatever or something.
Totally fair. I did this exercise with an economics major from the University of Chicago, an undergrad, right? And I was like, what if we took $100,000 out of your grandfather's house and gave it to you right now, tax-free? And he goes, well, I'm going to owe you, And I go, let's say you owe me 300 grand, right? Just I'm inventing numbers, 300 grand in 20 years. And he's just like, why would I do that? And I go, what can you do with that $100,000 for 20 years? And he's like, well, what do you mean? I'm like, well, you have 100 grand. What are you going to do with it? Because that's really the answer here. And he goes, well, what if I just put it in the stock market? I was like, what if you put it in an index fund, in the S&P index fund for 20 years? How much would you have? And he would have roughly $650,000 of 20 years of average returns in the S&P 500 index. So he made 650, cost him 300. So there's a 350 delta. There's some taxes in there. So he's still net up, I don't know, 100 grand, 200 grand, like whatever that math is. Again, that small answer doesn't change the big answer, which is you still like net made money. Like what you really have to do is use that $100,000 in a productive way that is going to earn you more than, call it, the appreciation of the home equity investment. Then it's a good trade for the family. But man, if you blow the money, you blow the money, and like no one can help you when you blow money. Like, sorry, nobody. And
yeah, that makes sense. I understand. It's very interesting. So I guess help me land the plane. Yeah. Like, so what has to be true for this to work at scale, and what would tell you early that it's not going to, I guess?
I think, signups are going to be registrations are a real good indication of whether it's going to work or not. Right, Sonny? So that's fine. I think it is an education. It is a willingness for families to start having better communications. And you can see that snowball happening where people will sign up and invite their mom and dad to the estate or invite the next generation and start having these conversations and using the assets and the called conversation starters that we provide or any others, right? That start actively engaging in helping families make and save money, right? If we can organize and optimize families' estate, my guess is, Sonny, if I did that for you, or once I do that for you, you're going to start telling your friends and your aunts and your uncles and everybody else. And I think it's really that viral sharing, if I can call it that, organic and viral sharing. That's when I know this thing's really taken off, and it's much more of an adulting movement than just a product. Does that make sense?
And is this strategy, is this unique to you guys? Like, is this something you guys uncovered and you're kind of bringing to market, or is it something like a strategy that a lot of other companies are also embarking upon?
So there are a lot of players in this, call it estate space, right? Just a ton, and they all have value. Yeah. Your wealth manager, man, I'm not here to do a Monte Carlo simulation on your portfolio. That is not my job. That is not what I'm ever going to do. I'm going to say you should work with your wealth manager on that. I'm not here to write you a legal document. You should work with beyondwill.com, trustinwill.com, a state attorney from Newport Beach, California. Like, I don't care what's right for your family, right? So I am much more of the Angie's List there. And so I think each one of these groups are trying to solve the same problem from their perspective. The wealth manager will be like, well, why don't you just stay in my wealth management platform? It's like, well, because it doesn't look at your real estate. It doesn't, you know what I mean? Like, it doesn't look at your insurance policies. Like, it doesn't do, your wealth manager is optimizing for the wealth manager. And like, mazel tov, like that's what they're supposed to do. That's what they're paid to do. Your estate attorney is trying to sell you a legal document every decade. That's what they're paid to do. That's awesome. Who loves the family, Sonny? Who loves the family more than the family? And that's our approach. And I don't think anyone is coming at it from the family's perspective where you put them at the hub, right? And everybody spokes in and out, because it's the family's wealth. It's not the wealth manager's wealth. It is not the estate attorney's legal document. It is the family's wealth. Let's protect the family. And so that is unique. That positioning is unique in the market as far as I can tell.
Cool. Where do people learn more? And then, yeah, after that, I guess, where do people find out more about you as well, Bryan? And I'll bring this one to a close.
Sure. So forwardinheritance.com. We tried to make it as verbose and simple as possible. And then, look, all the socials, we're on LinkedIn, Insta, Meta, all of those things, X. I'm also at BT Walley on most of those platforms as well. I got a lot of those nerd things early. So that's where you can find us as a business and me as a human. Yeah, and we would love, it'd be an honor to serve your family. It'd be an honor to help.
Awesome. All right, hang out for 1 minute, Bryan. I'm going to bring this stream to an end. See you in 30 seconds. Cheers, everyone.